All right, everyone. Welcome back to another episode of On the Margin. Today, I am joined by repeat guests, Nick Glinsman and Michael Cow. Guys, welcome to the show.
Brilliant
to be back.
Really good to be back, Mike, especially with the other Mike as well. This will be fun.
Yeah.
This will be fun.
We'll be Michael's 1 and 2, and Michael, you and I can duke it out over who gets the number 1 title. How does that sound?
Or you can call me Cowboy.
Cowboy is great. Cowboy is great as well.
Or Urban. We could call you Urban.
Yeah.
By the way, it's really funny because my Uber profile is Urban Cowboy, and a lot of people, wait, is this Urban? I'm like, okay, yeah, it's Urban.
Exactly.
That's a lot of good options for us here. We've got so much ground to cover here. I want to just dive right in. Ben, I'd love to, both of you guys are such good holistic macro thinkers. I do want to start at a high level and just get your sense of where we are. But maybe the best way to do that is actually to talk about everyone's favorite topic in macro and kind of the thing that all roads lead back to, which is the U.S. dollar, because that's going to have a lot of implications for talk about China that I want to get to and rates over here in the U.S. So I would just love to get your sense. Maybe Michael, I can call on you to kick us off because I think you appropriately catchphrase this the dollar wrecking ball. But talk to us about what's going on in the dollar and all of the different things it's impacting right now.
Yeah, I think after the peak in the DXY in fall of 22, a lot of people were very ready to call, the beginning of the next down cycle on the dollar. And I said, well, look, let's not so fast because everybody's so focused on the Fed's hiking cycle, but the issue that I see right now playing out in the world is that I think the state of the U.S. consumer is the strongest in the world, and it is going to force the Fed into higher for longer than the rest of the world can handle, especially China, as you can see, obviously, right? The reason why you're not really seeing the fireworks that we saw in fall of 22 is that the euro has stayed very strong against the dollar, relatively speaking. But the dollar wrecking ball, I tweeted out this maybe a couple months ago. I said, dollar wrecking ball is hiding in plain sight. Against Asia, the dollar wrecking ball has been swinging pretty hard. When I wrote that ball in a China shop piece back in March, that was at the height of the regional banking crisis. But I said, look, I think the real deflationary force that is going to be an issue in a couple of months is going to be China. It's actually not going to be this regional banking crisis. And I think that until the euro really falters, it won't be evident to the world. But I think that day is coming. I think that, the euro being 60% of the DXY, and given I'm sure Nick can give us the nitty gritty on German PPI and all the various industrial metrics, but it doesn't look good. And to really kind of summarize what I think the macro looks like here is it's going to be kind of a global synchronized shit show. As you see basically demand in the West start to falter as well, and that is basically one of the last outlets for China to be able to deal with its own internal fallout.
So fundamentally, I don't disagree with what Michael's been saying. I would say, I've sent you the chart. Hopefully, we can use it. Germany, the engine of the EU. Its manufacturing orders is almost perfectly correlated with China imports in dollar. Now, in terms of the deflationary side of Chinese, say, PPI on the rest of the world, I think it impacts Europe more. The US, funnily enough, and I read this morning, and I can't disagree with it, has become more protectionist. But when you think about protectionism in terms of the US, think of it in terms of the USMCA, the previously named NAFTA. Because the two biggest exporters to the US now are Mexico and Canada has just peaked over China's level. So I'm thinking that, this PPI deflationary pressure from China is going to have less impact on inflation within the US, maybe the dollar's going to have more impact outright than the PPI. It's a diminishing impact from China. Yes, there's an impact, but I think the dollar's going to have more impact. Now, I agree with Mike. I think the dollar against the euro, I think the euro should be a lot weaker, and I think it's coming. And the reason I say that is there is a correlation with China. And as my view is, and I mean, regardless of, it's Monday the 21st, regardless of a bit of weakness in the dollar offshore renminbi, which from what I understand is offshore funding limits that were suddenly squeezed hard at the end of the day and into London. The trend is clear. And if you look at the smile, which you may have seen today's daily, that I put that Forex smile that was made famous by Steve and Jen when he was at Morgan Stanley. The US are on one side, China's on the other. China's on the bad side. US is on the good side. So that's got a lot of synergy with what Michael's been saying. But I think even FX, everything's driven by US Treasury market. And I remain bearish on that. Back to dollar offshore renminbi, our target is above 750. We think even 8 over the next year. And, you buy dips on the ladder move up. But the Treasury market, I just think it's in a lot of trouble. It's in a lot of trouble.
Back to the drivers of the dollar at this point, right? So I think it's interesting because I think it's really two primary things that are going to drive this next round of dollar strength. One is it's not so much who is going to out hawk the Fed now. The question is who's going to start out doviing the Fed. So Asia, namely China and Japan, never stopped, right? I mean, despite this yield curve control tweak, which failed miserably, Asia basically has never stopped stimulating. You're starting to see Latin America also throw in the towel and start to cut rates. So I think the stalwart right now is Europe, and I observe that I think every central bank under the sun has been hoping upon hope that the Fed is going to engineer a global slowdown so that they don't need to administer their own medicine. But I think, and Christine Lagarde, I think, is stuck because, she, as Nick has pointed out numerous times, she's surrounded by a number of hawks from the Bundesbank. But the economic numbers coming out of Europe are pretty appalling. So I think one thing is who's going to start out dubbing the Fed. The second thing is what Nick alluded to in terms of the bond market, because as you saw during the fall, at first you had this interesting negative correlation between gilt rates, long rates, and the pound, right? Because initially that caused a real scare, and the pound tanked at the same time that gilt yields spiked. Well, now you see that correlation flip the other way, where pound strength seems to be driven by its long rates, and I think we're starting to see that creep into the dynamics of the dollar as well.
Somebody said to me today, "What's your objective on the 10-year?" Actually said last week, and I said, "Well, once we break 430, my next objective is 5 in the US 10-year." There's your wrecking ball, Michael. That's the wrecking ball. That's the thing that's going to really smash the dollar through all resistance wherever you want. Because if you think about it, back in the taper tantrum in 2013, it was the US bond market that had the tantrum that created the crisis in EM. But European sovereign bonds also, reacted to it. And I just think this will be one of those eureka moments. And I think also, if you look at the latest market statistics from somebody like Michael Hartman at Bank of America, a fellow expat, everybody's still long the bond market. It's only the hedge funds, the short. The big funds are all long the long end. And it was the same problem in the UK. They think every step up, they've got to buy more. And they're all sitting on these huge losses, but that's not necessarily their problem, as it were. So I think, I just look at the dollar correlated with the Treasury market. And if we're right on 5%, I mean, where would the dollar be? Also, the other thing of note is we've got Jackson Hole this week. I think there's a chance of Lagarde being slightly dovish and Powell maintaining the hawkish, maintaining what was said in the minutes, which was definitely a hawkish bias. But I think there's a possibility because even a couple of previous hawks in the ECB, on the ECB Monetary Policy Council have come out in the last week or two during the quiet period and said, well, we're not presupposing or presuming there's a hike in September. So I think Lagarde could possibly be the dove in the meeting.
I think the tell was back in July because her comments, which I honed in on, were that I think when asked, are we done? She pretty much said, yeah, I think we are done.
Yeah, pretty much said it. Yeah. Well, you mean at Sintra, and there was the Sintra conference.
Yes, exactly.
Yeah. Okay.
Yeah,
got you.
So, guys, we started to really cover, a lot of what I wanted to get at today. But maybe just to summarize, right? Obviously, a lot of analysts out there, failed to predict what was going to happen with the dollar this year, and the dollar, is being the most important macro, or kind of the combination of the dollar and treasury, so the most important macro assets of the world. And those ripple out into both Europe and China. Just to put some more concrete numbers, by the way, for folks who might not be as familiar as what's going on in China. I mean, the statistics do look pretty dire. And I think this is something people got broadly wrong, because if you remember back...
Can I smile?
You sure can if you'd like, Nick. Yeah, you sure can. You just remember that there was kind of a bullish narrative, right, back in January or February of this year, where the PBOC is cutting rates, and this was going to drive the next growth, the growth story for this year, yada, yada. But really, it was probably showing signs of stress. I mean, here are a couple of statistics just to rattle off here. Exports fell by 14.5% year on year in July. And that is, for China, that is a pretty crazy statistic. They're in deflation.
Is that
bad? That's not great. I mean, unemployment, just look at all the youth unemployment is at a record high. Credit growth has fallen to the lowest it's been since 2009. One of the biggest property developers is on the verge of default. And the
previous one is about to go bankrupt, right?
Correct. Right. Yeah.
Did go bankrupt.
It's just one thing after another over in China. Maybe just to land the plane. I mean, Michael, you're describing the importance of the euro and that potentially buckling. Can you just, for listeners who might not understand, what was the relationship there? Why is that such a critical currency to take a look at?
Because it's got a 60% weight in the DXY, and the DXY seems to be what most people associate with, like, the broad-based dollar. But obviously, the yuan is not in there because it's got a closed capital count. But one thing I want to just point out, going back to China, I think I have a kind of an interesting mental model I wanted to share with you guys, which is, you guys are familiar with the way noise canceling headphones work.
Mm-hmm.
Right? It's a process called destructive interference. Okay. So what it does is it samples the ambient noise, and then it basically flips it 180 degrees out of phase, and it essentially cancels out that ambient noise. Right. So that's a process called destructive interference. Okay. So the reason why I bring that up is because I think of our Fed right now fighting this destructive interference because it is trying to create near-term economic headwinds, and it's having a hard time because it's still got longer-term demographic sort of inflationary tailwinds that it's contending with, not to mention the after effects of the COVID fiscal stimulus. Okay, so but because you've got these two countervailing factors kind of destructively interfering with one another, it's giving us this perception of Goldilocks, and it's lulling everybody into this soft landing scenario. Okay, in the U.S. In China, though, you've got constructive interference, which is where China's property bubble bust officially with Evergrande and its 3 red lines policy a couple of years ago. But the thing that keeps sticking in my head is when I listened to that Odd Lots interview a while ago with Richard Koo, when he's comparing Japan to China, and he talked about how in Japan's case, it's shorter term balance sheet recession and spawned by the same property bubble bust happened in 1990. It took 19 years before the longer sort of demographic trend peaked. Okay. In China's case, you've got both trends peaking at the same time 2 to 3 years ago. So now you've got a short-term down cycle driven by this property, by this property bust, but it's being magnified or constructively interfered by the long-term demographic collapse. So when you take a step back and you look at how quickly things are deteriorating in China and what their levers are, I don't think, unless they literally do the kitchen sink in terms of both fiscal and monetary, they're not going to be able to stop this. And if anything, one of the big mistakes that I think people from the West have been making in every step of the way, trying to forecast a China reopening, is viewing PBOC policy through a Western lens. Because I don't think if you just look at what they're doing, it's not a bazooka. It's more like a pea shooter. I call it a 22 cal plinker. Just last night, or was it last night, Nick, that they lowered the LPR by like 10 basis points?
Disappointed everybody. Yeah,
to say the least.
Actually, what the PBOC needs to do is go full Mario Draghi, right? Cut
Whatever
things to zero or negative, and then go and buy all the crappy local government debt. That's what they need to do. They won't do it. Remember, we're in a regime of Xi Jinping. He's never stimulated. He's never done a big stimulus. Okay, it's just not. And also when you think about it, if you look at, I think I referred to this in our last chat, Mike. When you look at the writings and the public writings of Xi, he changed the order of the things most important for the economy in that Kyushu magazine article back, I think, in April, where exports, which had previously been number one, are now number three after the domestic consumer and infrastructure. Trouble that he has is where there's a balance sheet destruction that's occurred is the domestic consumer. That's the balance sheet destruction. They're all sitting on massive unrealized losses.
Yeah. They've
no idea what their real estate is worth. So he's got it, that's why I'm not sure, I just don't see the PBOC has done nothing to tell me this, that they're on the right path. I can't see them doing a full ECB on this situation. You've got no news on that basis whatsoever. Despite what the street says, there's still no hint that they're going to stimulate. It's just talk. So the one valve is the FX rate, cheapening the FX rate. And I think that's why it's sort of inevitable. But my thoughts as to why the market hasn't really gone for it, I think they've gone for it, but very timidly. People are worried about the Chinese intervening, so they can take it back down to 720. I'd go and buy more, right? I'd go and buy more. Please take it down to 720. I'd go and buy more. Absolutely.
Yeah. I'm actually looking for a re-entry point myself because I got out of my last bit around 725 and I actually switched to the Hong Kong dollar because I thought that, they're overdue for a strong, intervention.
Yeah. One other part of the China story as well, which people like to talk about, is the debt. And I'd be curious to get, Michael, you, in your piece that you wrote back in March, you had a great sort of contrast of charts of the public debt for China versus some of the more hidden private debt or debt in the private sector. Can you just talk to us about the leverage that's in the Chinese system? How you actually try to quantify that across different sectors, and then is that part of the problem as well, or how does that eventually get dealt with?
Well, that's the difficulty, right? The opacity of the entire system. Because I remember when I first started really taking a close look in China, actually a year before that piece, probably around March of 22, when the yuan was around 6.25, 6.5. And I remember getting into these debates online about somebody who shall remain nameless, who is always a big fan of the Chinese yuan, was basically touting how look, I mean, the dollar is doomed, and look at the yuan at 6.25. And its balance sheet, the PBOC balance sheet, is just pristine. And that's what prompted me to really push back and say, what are you talking about? This whole PBOC balance sheet is a facade, because the amount of off balance sheet financing through the LGFVs and the SOEs would make Enron blush. I mean, it's literally Enron writ large on a sovereign scale. And so at some point, we don't know where that point is. At some point, I think that has to go on the PBOC's balance sheet, because there are limits to how many of these how much rug sweeping can be done. And I think we're starting to see that the beginnings of it, at least with these very, very big developers go under. But again, it's very, very difficult to get the true numbers out there. Brad Setzer has been, he wrote this whole piece about how he thinks China could have, 3 trillion in additional shadow reserves. Well, I don't know about that. I know that
to me, that's the biggest risk. That's the biggest risk. And I'll let you finish, and then I'll come in.
I was just going to say that, probably. If the shadow reserves are really that high, probably at least one of the 3 has been torched through One Belt, One Road. And a lot of those debts are not recoverable. So, we'll see. I do think, just one last point, what Nick, you were saying that you think that the yuan will go to all-time lows. I think that's a possibility, but I also do think that what gives me a little bit of pause in recent weeks on that thesis, at least on the thesis of a disorderly devaluation, is that the PBOC does not seem serious in wanting to halt this deflationary spiral. I don't know that their policy objectives can be viewed necessarily through a pure free market economic lens like we're used to. And that's what concerns me a little bit.
The current governor is a political ideologue, isn't he? He's full CCP. Now, people have touted him as experienced in looking after the currency. Okay, show me. Show me. He is full political ideologue. Now, going back
to the new guy, you're talking about the new guy.
The new guy. Yeah. Okay.
Yeah.
Going back to the reserves, I misconstrued the road you were going down. I'm looking at the shadow banking situation.
Yes. Yeah.
Pure and utter Ponzi scheme based 100%. Off the real estate market. That's the assets, and they need to get more money in to be able to offer products at a higher rate. But this is a Ponzi scheme. Now, I would posit the first signs of trouble, if you connect the two, occurred 3 years ago when Evergrande started to get into trouble, right? But actually, I think it was more COVID, if you took that view, because it's a house of cards and it's a Ponzi scheme. All you need is one of the lower the lower rungs.
Nick,
and it starts.
Can you describe it for listeners? How is it a Ponzi scheme? Like, what does it look like?
Well, the shadow banks have to. They guarantee their collateral is real estate. Okay, on a lot of these trusts. So if you've offered $100 million worth of something that pays you 7-8%, right? But you've just lost 40% on the collateral. Who knows what you've lost on the collateral?
Yeah.
When that comes to mature, they've got to find new people to buy a new product to pay off the maturity of that debt, right? And it just rolls right through the system. So you'll see more and more of these situations, and that's why that's perhaps where there's 2 areas that the PBOC has. If they were going to do full Draghi, would be the real estate debt. 3 areas. The the local authority debt, and these shadow banks. There was violent riots last week when Zonji announced that they're not going to pay a coupon, right? So these are this is enormous, right? Enormous exposure.
That's a huge market.
And then you just think of the real estate market, and you think of the local authority debt. It just rolls up. And it sort of implies, if you were logical, it implies that you've got to reset the economy. If that was in a Latin American country, they'd just reset the currency, like the Argentinians want to do, perhaps, but they're not going to do it on the dollar. But did you see that the Argentinian opposition candidate, his plan is to actually ditch BRICS and basically ditch BRICS, ditch the central bank,
and embrace the U.S. dollar. So I call that shitting BRICS.
Yeah, quite. I mean, to be honest with you, the same with the Indians. They're not going to do this. What people don't understand about this BRICS plus currency or commodity-backed currency, one of them has to step up and control the price of whatever's underlying. The Chinese will always do what suits the Chinese, not what suits the others.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our Permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. Now, you've heard me say this many times on our show before, but the time to be bearish on crypto was 18 months ago when the Fed began raising rates. Since then, our entire market is down more than 50%. We've had all this bad news. In the last 2 weeks, we had BlackRock and a whole slew of other institutional investors file for a Bitcoin ETF. This space is not going anywhere. So if you're interested in investing in this space at all, I highly recommend that you attend this conference. The other thing, and I've said this before as well, bear market conferences are the best ones. In the bull market, you have all this retail, all this noise. Now you only have the people that are really here building great products. This one is worth your time 100%. And since you are such good listeners to On the Margin, which I really appreciate, giving you all a special 30% discount code. It is MARGIN30. Now you can access that by clicking the link in the bottom of the show notes. So you can see my fingers pointing down, click that link. Because you are a listener of On the Margin, you get 30% off to the conference. Again, the code is MARGIN30. We'll see y'all there. So just to maybe, bookend this, the China situation looks bad from almost any statistic that you can look at. And then there's sort of this extra almost, negative call option in the form of, this has the potential to be a gigantic Ponzi scheme that's being operated right now. Or at the very least, the assets that are supporting the economy are probably not marked to market in the correct way. So
definitely not marked to market.
Definitely.
Yeah. So the implication of this could be that if the deflation over there gets bad enough, or if there's concern that the financial system could come apart, there would be a devaluation in the currency. Right? Is that about the size of it?
And the one thing the PBOC will never have is effectively the cooperation of the Fed and the other G7 central banks. That's not available to them. There's no swap lines available to the PBOC. And any swap lines that used to be available to the HKMA in Hong Kong,
gone.
Yep. And certainly this situation over there is not being helped by what's going on in the US vis-a-vis the rate markets or the dollar. So maybe this would be a good time to transition to what's going on over in the US. And we started to get into this earlier. Nick, maybe you can do a little bit of a victory lap on your call for treasuries. And particularly what I want to start with is what's just been going on on the longer end of the curve. I mean, rates have been skyrocketing across the 10-year, 20-year, and the 30-year. I mean, what's driving this move? And then we can start to unpack the implications.
Well, I think it's been clear to me that outside of the more speculative accounts that you see on the weekly COTS report from the exchanges in Chicago, they're all long treasuries. And that got confirmed to me by several charts, one of which was Michael Hart at Bank of America. They're long treasuries. They're long duration. The market is long duration. The nearest equivalent I have is what I've seen happen to the UK gilt market. People these long only funds, these pension funds just keep buying. Every time the yield goes up, they'll buy some more. So the market's long. And that buying brings in the more speculative, the more speculative accounts will short cover and buy some for a trade. People just get caught. Now, what really gave this legs? A couple of weeks ago, you came out with the announcement on the fiscal deficit being 1.7 billion from the CBO. It's huge, right?
Huge.
For the quarter. It was a quarter. And then you had the refunding announcement, which is a substantial amount of money on the refunding. And when you think about it, who's going to buy this? Foreign official players? Probably not, unless the Japanese help out. And there's a political reason why the Japanese could help out. Definitely not the Chinese. So foreign players are tough. That's a tough one. The only buyers would probably be the domestic players, the pension funds, insurance companies, and so on and so forth. I have heard a rumor that the treasury is building a massive buyback account, but I find that Yellen cannot do that quietly. And if she was seen it in there buying the market to prop it up, that's more debt buying debt. It's a neutral trade at best. Would you agree with that, Michael?
I would think so. I want to point out one big picture observation that's divorced from the 2 points that you just made, which point to continued bear steepening, which is about 2 months ago, I observed that there's this interesting feature on Coifin that lets you look at, you can plot twos, tens in all the major sovereigns, right? And so I started comparing twos, tens in the U.S. to Germany, to China, to say Italy, to Japan, et cetera. And I was like, wait, this is crazy, because the twos, tens spread in the U.S. was at negative 100 basis points, right? When you've got essentially China and Japan at positive 60 basis points. This is back at the beginning of July, right? Right. At the same time, when you look at the macro data in terms of GDP, just various whatever metrics, unemployment, et cetera, like, okay, the relative strength of the U.S. economy, right, suggests that if anything, our twos, tens spread should be far, far less than some of those other economies. If anything, the relationship should be inverted, right? So I pointed that out about like 2 months ago. I'm like, okay, it just doesn't make sense. And so, with respect to the Fitch downgrade, with respect to the refunding surprises, I think those are all certainly catalysts for the turn. But I think this is symptomatic of a much bigger fundamental mispricing in our yield curve versus the rest of the world's yield curves. To give you an idea, even with this, collapse in the long end, right, or this big sell-off in the long end, today the US twos, tens is negative 65 bips, and China's is positive 46. It's still so mispriced, and that's what's scary.
How do you think that mispricing ends up resolving itself? And by the way, you've referred to, I think it's an important concept for people to get bear versus bull market steepeners here. I've heard you, I think, predict correctly, right? A bear market steepening, which seems like that's what's going on today. So for listeners, can you just define what is a bear market steepener? And then how do you see this mispricing between the twos and tens versus US versus European economy and China resolving itself?
No. To be quite correct, I was wrong on my call for a bear steepener, because I wrote a thread last summer about it, and really as a sort of a policy piece, if you will. And I was suggesting that rather than okay, so back to definitions. Bear steepener is when long rates move higher relative to short rates, even as the Fed is taking short rates higher. A bull steepener is the opposite, where, a bull steepener is where short rates are moving lower than long rates, relatively speaking, but that's usually happening in an easing cycle, right? And so what I was suggesting in my piece that I wrote, I think it was in August of 22, was that and at that point, I think our short rates were still around like 2 and change, maybe when I wrote this, or maybe it was June of 22. I said that, look, the Fed has only one tool, which is the front end of the curve. And perhaps it needs to think out of the box and coordinate with Janet Yellen and try to engineer a bear steepener, because I estimated about 3 trillion of our, call it 16 trillion in corporate debt to be floating rate debt. And I said that, look, if you're going to take Fed funds up to 5 or 6%, and by the way, this is when Fed funds was at 2%, you're going to wreck a lot of things. You're going to start breaking the banks. You're going to eviscerate net interest margins at the same time that floating rate loans are going to start creating, elevated default rates. But if you could engineer a bear steepener that has the effect of depressing long-term, high duration asset values, right, and perhaps we could have had this situation where Fed funds might have peaked at 3.5%, but long rates were at 6.5%. But obviously, that requires a lot of and an unprecedented amount of central bank and U.S. Treasury coordination to be able to engineer something like that. And so,
managing QT, alternatively managing QT instead of letting the roll off from expiring treasuries back into the market, sells them at the long end.
As U.S. citizens, we should be very, very frustrated that the U.S. Treasury did not issue like 50 or 100-year bonds when the 30-year was basically yielding 1.5% or something. I mean, it boggles the mind.
So a couple of weeks ago, right, the two catalysts, right, that people like to point to is, first of all, the CBO kind of blew everyone away with the fiscal deficit that we're expecting, which was, I think that the headline already was probably a year ago or something. I can't remember exact dates. They came out with this estimate that it was going to be 1.8 and then got revised up to $2 trillion a year for the next 10 years. And, always with these estimates, it's always worse. It's never better, right? It's always worse than they estimate. So that puts you at a pretty high, astronomical number in terms of what the U.S. debt is going to look like in the coming years. And we also got Fitch downgrading U.S. sovereign debt to AA+, right, which was also bad. And that correlated with this move in the long end of the curve. And I think the question that people are asking right now is who's going to buy all of these treasuries, because at the same time that the Fed is hiking, they're also doing QT, right? Yeah. So just right there, you've removed the largest buyer of treasuries, and you already have some of the big foreign buyers of treasuries, namely China, right? They're actively moving away. Some are already much further. Like Russia has completely stopped buying treasuries, I believe, from. It's
not their choice.
Right. Yeah. So how does this end up resolving itself? I feel like I continuously come back to this question. I feel like a lot of macro is very focused on the monetary side of things, but the fiscal seems to be what's really, really driving things right now. Like, how do we resolve this deficit that, like, Michael, you mentioned, Americans being frustrated that we didn't, offer 10 or 100-year debt. I mean, as an American, I'm frustrated that we just can't seem to move the ball at all in terms of just spending ridiculous amounts of money, especially as a pretty young American. How does this situation end up resolving itself?
I have 3 things to say about this sovereign debt endgame question, which I think is a great question. So in October of 22, I wrote a thread that is called Geopolitical Mosh Pits and Sovereign Debt Endgames, where I kind of try to walk through what would happen in an endgame type of sovereign restructuring. So first is, when you look at the first point I want to make is the can be kicked for a lot longer than people think, especially if you are the world's reserve currency, right? Exactly. I mean, when you look at Japan, for instance, right? Look at how they have, they're in uncharted territory, right? but they have kicked the can successfully for much longer than anybody thought they could. Number one. Number
UK
two
can
is
do the same thing, I think. The UK,
yep.
Where the stress will be in the European Union, of course.
Number two is it's always tempting to try to run straight line extrapolations on where we are currently, given where rates are right now. But recognize that boom bust credit cycles happen, and so at some point, right? I think the Fed will win its inflation fight. And by the way, I think the two things that the Fed will have to break, it could be both, is either our labor market and or China. And China's already breaking, and rest of the world, by the way. So boom bust cycles happen, and at some point we'll have another easing cycle, and interest rates are going to go down again. So we can't extrapolate ad infinitum the current interest.
Will the interest rates go down to zero, or we're going to stop at 3.5?
That's a great question. I happen to think that we can't return to ZIRP for a while, because I think there are structural factors that'll reignite the inflation for a while. But the last thing I want to talk about is the sovereign debt endgame. Like, what actually happens? Because I spent a lot of my hedge fund career in the world of corporate restructurings, right? So in the world of corporate restructuring, when you've got an over-levered balance sheet and you wipe out the old debt basically becomes the new equity. It becomes post-reorg equity, right? Well, what is the question is, what is the sovereign equivalent of post-reorg equity? They've toyed with different types of, in the past sovereign debt restructuring, they've toyed with various, like, for instance, like warrants on certain economic assets, et cetera. But where I wanted to leave this part of the discussion is that the reason why I am still relatively bullish on the U.S. vis-a-vis the rest of the world on this regard is, even if we fast forward way into the future where the U.S. has to basically restructure its sovereign debt, it comes down to national assets. What are those assets? And so when you talk about the U.S.'s geographic assets, you talk about its natural resource assets, they're still unparalleled in the world. And so ultimately, that's what drives even the endgame restructuring.
You see, I disagree with the endgame. I've had conversations with various officials at the right places. The endgame is easy. Sovereign debt jubilee. Do we agree that the Fed is part of the U.S. government's balance sheet?
Right.
Yeah.
On each side of the balance sheet, let me get that right, there are two equal and opposite numbers. What the Fed holds and part of what the Treasury owns. Well, what's the point? Because the Fed has to pay back the interest. So clear it from the balance sheet.
Well, it matters.
Now, it
in
would
a
have an
relative
impact
value
on
world.
Markets and currency. It would.
You could argue that the Bank of Japan could do that right now, but the reason why they haven't done it is because presumably that would probably torch the yen, right? So you could do it once, but if the rest of the world isn't as in dire a shape as you are, and you do that, then you have completely shut yourself off from external financing forever. I think.
The two central banks most likely to test it is the Bank of Japan.
Right.
Much more probable than the Bank of England. And neither would test it without talking to the Fed and the American authorities. It's very significant that Ueda is fluent in English and talks to the Fed regularly. There is a significance to that, particularly given the current geopolitics where the Japanese are committing much more expenditure on the defense side as well. Okay? So it just strikes me that if you could get an agreement, you'll never get the ECB to do it. They don't know where the other side of the balance sheet actually is anymore. And that would actually cause stresses to the structure of the European Union, I suspect, or the monetary system. But you could get Fed, Bank of England, Bank of Japan say, okay, we're going to announce this on Monday morning or Sunday night before the markets open. Why not? There are two equivalent sides of the same balance sheet. What's the point of doing QE? Cancel the those two aspects of the balance sheet, the liability and the asset.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. I have a question for you guys. What do you think that does to the credibility of the entire system? I do think one of the, I forget which one of you is describing this idea of sort of escape valves, right? And I would argue that one of the escape valves.
It was me on China, wasn't it?
Yeah. I would argue one of the escape valves for this philosophy that the Fed has of blowing asset bubbles. And I say the Fed, all central banks, kind of blowing asset bubbles and devaluing the currency. Who's it really hurting?
Yeah,
I think who it hurts is actually something that's less visible in a set of financial statements, but it's credibility in the system, and it is wealth inequality.
Exactly, and wealth inequality.
Agreed.
Right? It's wealth inequality, and I think if you set this system up that everyone knows in their heart of hearts has a BSE Ponzi-like kind of element to it, it favors a very small group of people. And right when the consequences are coming due, you just cancel the whole game and start it over. I just can't imagine that has no social consequences. I don't know what that ultimately ends up playing out like, but I think one of the great harms that these central bankers that kind of act as these almighty, arbiters of the market have done is it's ruined a lot of credibility in the system, at least from my perspective.
To make more errors and the ECB to make more errors. A Bank of England, it's a constant thrush of errors. What I would say is it's interesting, the quality of the minds at the central banks. You've got a lot of weakness in certain key areas. Okay? I mean, Christine Lagarde has no idea about economics, even though she used to run the IMF. None whatsoever. If I can be slightly flippant about her, she's an indicted French lawyer that was indicted in France, right? Then we look at Andrew Bailey. He's from the regulatory side, not a monetary policy economist. Jay Powell from private equity, not a monetary policy economist. The nearest you have is actually the Bank of Japan. It's got monetary policy economists. The Chinese, it's political ideologues over any economic pragmatists whatsoever. So that to me is problematic. In the older days that Michael can probably remember, and I do remember, the boom bust was Philippe.
Thanks, Nick.
I said probably, and then I said I can remember, and it's way before Mike was born. Boom bust was accepted, and you would have counter-cyclical fiscal policy. So in bad times, fiscal would step up. In good times, fiscal would take it back. Here, it's all pro-cyclical. One area that I tend to think has been hugely inflationary, because it's also disguised protectionism, is the U.S. fiscal policy stance. Yes, we had much more back in COVID, but bloody hell, what they're spending right now. And, I saw an article, if you think of rare earths, and I'm going back to some of my commodity days, rare earth metals and how the Chinese have 80-90% of all processing. Not 80-90% of all the metals, but 80-90% of all processing. To construct mines and build processing in the US, $100 billion in 10 years. And the trouble is, it takes 5 years to get the necessary authority to build, right? Because of rare earths are not clean. It's not a clean process. So you can, that 100, and that was from Boston Consulting Group. Noticing they're going, only 100? No, that's got to be going up like that, not 10 billion a year. It's just got to go up like that. And that's the other problem with the fiscal side of the US. You saw it with the CHIPS Act, but you're going to have to see it in other key areas where the supply chain can be disrupted by the Chinese. They've got to attract more of that production, whether it's rare earths, whatever it may be. This is an enormous expense as well. And, probably they would put it national security. So it comes under defense budget, right? So, that's why I see, that's the problem I see with what we've got going on. I mean, whatever happened to tax subsidies to attract businesses in, which you're seeing within the US, Florida and Texas, right? Businesses and individuals, with the exception of Michael there, who loves paying high taxes in California. But you're seeing that on an individual and a corporate level within the US. Why not go that route? Hits the balance sheet a lot later, and it's actually not necessarily a balance sheet hit if that process has created jobs, production, so on and so forth. Powell never talks about fiscal. Never.
He's gotten asked about it. He's gotten asked about it, and
refused to talk about it.
Yeah, I agree.
Go back to Greenspan. Well, we can't cut rates with fiscal at where we are. Greenspan had Volcker had no issue whatsoever talking about fiscal. Bernanke had a different fiscal issue because he had comes in and GFC, off we go. But and Yellen never spoke about fiscal because from her political standpoint, the more they spend, the better it is. Okay, so now Powell, I don't know why he's never spoken about fiscal, but especially given he's a Republican and the Fed is not a democracy. Never understood why. Because that is the problem they're facing. Doesn't matter what they do, fiscal more than compensates for a lot of the tightening that's occurred. Would you agree with that, Michael?
Agreed.
Yeah.
So, what I was going to touch upon though is what you were talking about in terms of inconsistency of different, I guess, industrial policies. And so, back in February when I co-wrote that paper that we presented at West Point, one of the things that we pointed out was that, our free market system, right, while very good on so many different fronts, exposes certain fissures that allow an autocratic state like China to attack directly through economic means, right? State-directed economic policy. And it puts us at a big disadvantage when it comes to, for instance, your rare earth example. Now, what's somewhat heartening that I was actually pleasantly surprised that this administration carried out was what it did with respect to targeted export controls and chips. But then, before you get carried away, you look at what the same administration has done on energy policy and emptying out our SPR, and you're like, what are we doing? Who has stockpiled all of the crude that we've let go? It's China. Right. So in one of the topics that I've been talking about with Grant Williams in my new podcast series, in the Chaos Theory, is that this notion of economic warfare and how it almost behooves us. I mean, when you look at like when you talk about the U.S. Army War College espouses this framework called DIME of the four pillars of national power: diplomatic, informational, military, and economic. Well, if you think about the DIM part, the diplomatic, information, military, we have government apparatuses set up in each of those departments, right? Diplomatic, we have the State Department. Informational, we have the CIA and just media in general. M is obviously all of the U.S. Armed Forces. But we have no economic force that actually presents a cohesive strategy. And maybe that's impossible in a federalist republic like the U.S. Maybe it is, but I posit that we need something that's less disjointed than what we have to confront an adversary like China.
Well, even on the defense side, it's disjointed. So you have DOD and Pentagon, but behind the scenes, Indo-Pacific Fleet, U.S. Fleet 2, all these fleets, the Navy is really commanding a lot of the progress in arrangements and agreements between the U.S. and other countries. It's absolutely. So, and again, that's something that Harold has really focused on. So the trouble is, that means that what you hear from where you would normally be expected to go is not necessarily in sync with what the military itself and the naval commands in the various regions have been working on. That muddies the waters too. In terms of the information side, and I'm not saying this because I'm flying the British flag, there's a huge dependency on GCHQ. Huge when you think about it. And it was always a point of contention that the French, when the British were part of the EU, that the French didn't have access. And the reason they didn't have access, like with the Germans, is, well, it's going to leak. We don't want it leaking. This is, this whole arrangement is effectively older than the EU. So, I look at this administration, the diplomatic side is an absolute bloody disaster. The messaging is always changing. If you look at Kurt Campbell on China, he's way more hawkish than Blinken, and in between is probably Jake Sullivan. Now, the interesting thing about this is, I don't think in China, with respect to China, we saw that reverse CFIUS come out, and it was a real disappointment. It was just, an empty gesture by Biden. But, Yellen ran to Beijing to explain it means nothing. Okay, so that's going to be left to Congress, and Congress is going to do a way more tighter level of restrictions. And bear this in mind, it's got bipartisan support of significance. So in the Senate, they recently funded. They were proposing in the NDAA funding for the reverse CFIUS. I believe it was the reverse CFIUS. It was 91-6 was the vote in favor. That's some bipartisan support. It's the only thing all members of Congress actually agree on, or most of them. And we suspect that will be becoming an increasing topic in the election. Okay, and if we get a change of administration and it becomes Trump, it'll be tariffs as opposed to other bits and pieces. You need to see Congress step up and do the right thing. But other areas that Congress cover, like the deficit, like the finance, it's just going to be impossible, isn't it? Because that's where it's, real partisan sense and sensibilities. But it's interesting that China's the only topic that the majority agree, regardless of which side of the aisle.
Yeah. It's China and increasing the deficit are the two things that have partisan support in U.S. Congress. Well, the thing about China, I want to dig in a little bit, Michael. I know we're drawing close to the end here, but Michael, I do want to dig in and get your sense on what are some of the economic instabilities from a geopolitical perspective that you see. I mean, this is sort of there's no Shangri-La in terms of forms of government, right? There are pros and cons in general, and the pros of the open democratic free market system that we have here in the US is that it encourages people to come over and build businesses. And you have, so why you have the deepest capital markets in the world. You have also strong property laws and that sort of thing. So people want to come over here and build business. The downside of that is that it's harder to coordinate. And sometimes the market can do things that are short-sighted or not within the perceived national interests from the government's perspective. In China, they can do that. They can be very command control, and there can be a central entity that can act very efficiently and very quickly in terms of making decisions. The downside of that is that over time, there is maybe some wisdom of the crowds phenomenon where it's very hard for a government over a period of time to just consistently get it right. And one example that I would point you to in China's history is the one-child policy, which at the time might have seemed from the perspective of the US like, man, I wish we could do that. But look at how that one is just bitten them in the ass. I mean, that looked like it was a good policy for many years. And now it's incredibly destructive. It's probably the single biggest threat that they have to overcome. So that's always where I end up coming down on some of these topics. It might look good in the short and even in the midterm, but there is something 100%. About wisdom of the crowds that gets it right over long stretches of time.
Oh, free markets. Yeah. I mean, go, and then just looking at the state-directed, growth policy of the last several decades, right? And how many bridges to nowhere and ghost cities can you have? I mean, the last time I visited China was in 2014. I was in the Yunnan province going to Shangri-La to go someplace exotic, and I had to drive through Kunming, and even in 2014 there were just ghost cities upon ghost cities. I actually even shared it on Twitter a couple weeks ago. I mean, so it's obviously all coming to a head at this point. And the thing is with these autocratic systems that also shield their data from light. It's hard to say when the proverbial Minsky moment will be, right? But it's also hard, I think, to view, again, going back to what we started this discussion with, the danger of viewing PBOC policy levers through a Western free market lens, because a lot of their policies are simply just not driven by economic well-being that we think of, right? But where what really concerns me is this youth unemployment of 21.6% or whatever it is, right? Because at some point, if that gets bad enough and you have a restive population, that we saw a hint of that during the COVID protests. Obviously, we saw a big hint of that in Tiananmen Square. But what do you do when things really break down for the masses and they've got a lot of people, right? And so the wag the tail response is, right, potentially go to war, and that's very, very worrisome. I recently read a book called Danger Zone, which talks exactly about this point about where when you've got a Thucydides trap problem of an up and coming nation that also happens to know that its best days are behind it from a demographic and economic development standpoint, does it make it more dangerous in wanting to do something rash, like a power grab across the Taiwan Strait? So that's the worrisome implication of if the PBOC really doesn't stem this economic freefall, do things get bad enough that prompt them to do something kinetic and rash?
I wouldn't even use the plural them. It's right down to she. It's where every decision stops. And he's not. He's less interested in the economy. He's a political ideologue. Doesn't care about economic pragmatism. All decisions stop. We've argued that by adjusting the various services, where they took out. We talked about this the last time. They took out the security agency from the CCP. It's now separate. It's now got its own leader, Yang Xin, I think, could be. I can't remember the name.
I mean, he's just surrounded by sycophants.
Also, let's not forget, he's never stimulated since he's been in power. There's been no stimulus under Xi. None whatsoever. Bits and bobs from the PBOC, but no stimulus, no real fiscal stimulus. Think about, real estate market, Evergrande. Think of what he did to the tech companies. So he's basically, on the tech side, he's destroyed private enterprise and the desire to do well originating private enterprise. On the real estate, he's just crushed basically the one area he wanted to show economic strength, the consumer.
Yep.
Right? So none of it makes sense. And it seems that Li Keqiang got it right before he was ousted. But there seems nobody there that's going to tell him this ain't working. This is a real crisis. Mike.
Oh no, I was just gonna. I know we're drawing close to the end here, and I actually want to end it by getting us returning a little bit to the world of macro and finance, and getting you guys to dust off your crystal balls for the second half of this year. I mean, we're already into near the end of August, but we've talked about the impact of the dollar, long bonds. I mean, how do you see the rest of this year ultimately playing out? There's been a lot of discussion about a recession that never ended up happening. Michael, I love that almost like amplitude canceling out analogy that you gave us there. That was really neat. I mean, is that what ends up continuing for the rest of this year? Where do you see sort of the major asset classes in the form of bond, stocks, commodities winding up end of this year?
I worry that we are going to see something more dramatic than not. I'm definitely not in the soft landing camp. Last summer when I wrote the thread on the Asian Contagion 2.0, I noted that, look, it took 18 months from the summer of 97 devals to metastasize into the Russian default and LTCM collapse at the end of 1998. So these things take time, but when they happen very, very quickly. I'm very, very concerned about where risk assets are priced in the U.S. I'm very concerned about oil because I personally have a large exposure to oil private equity. I think pro-cyclical commodities are very vulnerable in a global synchronized shit show scenario that I talked about earlier, led by China this time. And it's kind of funny how it used to be that people said, okay, look, if China coughs, the world catches a cold. Well, what about when China catches hemorrhagic fever, which is happening right now? And it just seems like so many assets are just whistling past the graveyard and just saying, oh, well, somehow, let's take oil. Oil is going to thread the needle of all this. But I'm very concerned about a lot of different risk assets. So, Nick?
I'm going back to the original proverb, when the US sneezes, the rest of the world catches a cold. Because I think with China, the street and the genuine desire to believe something's coming, copper's up today. What the hell's copper doing up? Right? It's all about, iron ore. Iron ore's up. Why? It's all on a mistaken belief that the Chinese are going to do something. And the interesting thing is when you hear about, according to people familiar with the idea on Bloomberg, China is about to provide stimulus. That's not where I would look for Chinese data. They did the same with Bank of Japan. Bank of Japan is doing nothing. No, it's going to do something. So I think the bigger problem is, the sneezing of the US could be started by higher bond yields, right? Pushing that dollar up and breaking other countries. EM goes first. Now, is China part of the EM circle? In certain respects, it is part of the EM circle. We'll never admit it. So that's where I think, we've got to 434, which was the previous high. 433 was the previous high. I think we're still slightly above it on the 10-year. 30-year, 445.5. Why would we suddenly stop if we're right there? In the old days when I was trading aggressively, if you're right at resistance, you go and push the resistance to make sure, you go and sell size to make sure that resistance is taken out, and then watch all the stops come in and
fish for stops.
Exactly. I think where there's pain in US bond positioning, there's pain in China positioning. I know there's been a lot of selling, but clearly people are reluctant to. What China doesn't get is the short interest that really goes with it. There's so many people on anything will go in and buy China, KWEB, the ETF for tech. Why? I mean, they're just punting. It's just punting all the time. And that's really unhealthy market. So I think if we think China's economy ain't going to do anything. Stimulus is pushing on a string. PBOC so far have not really shown that any hand. The only thing that will work will be full Mario Draghi, bazooka, ZERP, and full QE. Okay, so
I don't see that happening.
No, but what happens to the yuan on that basis? Tanked, right? Absolutely tanked. So I think, given that that's a hard one to call, I'm focusing all my attention on the US Treasury market, the other major sovereign bond markets, EMFX, because I don't see any reason for this Treasury market to slow down on higher rates. The reasons are still there, okay? And I think there's a lot of horrible losses. This is a thin week this week. People get back to their desk and see where their mark to market is, even if they don't have to. They may have taken 2 weeks off on holiday and be in the Hamptons. They come back. Suddenly they don't feel very well anymore. So I think we've got to watch US Treasury market and its impact on the dollar. At some point, the euro goes. Okay. And it could be this week at Jackson Hole. It just could be, with opposite sentiment expressed by Lagarde first and then Powell. I don't see any reason for Powell not to maintain what was said in the minutes. Lagarde, on the other hand, there's enough people who were previously hawks coming out going, it's not guaranteed that we're going to do anything in September. So, that's where I am. I think, and what's satisfying to me is, in the old days, everything was driven off the US Treasury market. Everything, right? We're sort of headed back to that environment a little bit. I mentioned to you that we've had an incoming inquiry about joining a firm. Now, I've had several inquiries about joining a firm because, quote unquote, I'm old enough to remember 1994. Great, thank you very much. But in terms of risk, those guys are the ones that remember. We haven't got enough of those guys in the market anymore, right? They've all retired. They made their money. There's not enough of them in the market. And you can see by this zigzag all the time. Look at the NASDAQ 100. We're at 734 rounded, okay? NASDAQ 100 future index is up 214 points. It's a long duration asset.
It's incredible. I tweeted about that today. Unbelievable. It
makes no sense. And this is the problem. And this is where you, Mike, are seeing it, that there are things that have been happening that makes no sense. And I think also the authorities have been somewhat culpable. 0 days to expiry options, that's just turning the market into a bloody casino. It's just absurd, right? So, keep your eyes on the Treasury market. It will tell all. It will tell all. The wrecking ball.
The wrecking ball. All right, Michael, what were you going to say? And then we can close out here.
Yeah, I was going to close out by saying that, about a month ago, I was invited to speak on a panel with a bunch of real estate experts, operators primarily, and public REIT CEOs, et cetera. A lot of them focused on the retail side of real estate. And what was amazing to me was how generally sanguine everybody was. I never would have expected to hear that, occupancy still being in the, mid 90s and, rents still actually going up. And it all comes down to what we opened this discussion with, right? My whole sort of this fake Goldilocks, because of this destructive interference between long-term structural issues in the U.S. that are keeping keeping the labor market tight, keeping shelter inflation elevated. And it's directly at odds with what the Fed is trying to engineer. And the danger to me is that it's going to force. I wrote that the name of that thread was, I call it the Ivan Drago Fed. Because if you guys remember Rocky IV,
he loves his titles. Go.
The big Russian that said, to Rocky, I must break you. Well, that's the Fed, because I think the Fed, by dint of this resilience in the U.S. consumer is going to be forced to break one of two things. I think either the linchpin for the U.S. strength is the labor market, because until people start losing their jobs, they're going to continue to pay their rents and continue to consume, et cetera. So that's the key thing to watch out for in the U.S. But then externally, the thing that could metastasize is something like a China blowing up. So those are the two things that I'm watching for. That might make the Fed finally call it quits on its higher for longer.
Guys, you've been super generous with your time. This was such a fun conversation. If folks want to find out more about you, follow the work that you do, what's the best way for them to do that?
Twitter for me at @Glinsman. And then I can happily lead you elsewhere to get more information. Michael?
For me, it would be at Urban Cowboy with a KAO on Twitter, and then urbancowboy.com. That's my Substack.
Awesome. Excellent, guys. Well, this gave me a lot to think about, and I'm sure our audience as well. We'll have to do this again soon.
This was great fun.
Now we need a whiskey, don't we? Now we need a whiskey to cheer up.
Exactly.
All right. Great stuff.
All right.
Thanks, Mike.
Good stuff.
Bye, guys.
Thanks, guys.